let's break down different futures markets and how to choose a market that is suitable for you based on a different factors that are important. So, what makes a good market? There are different characteristics that you want to be considering when you are choosing a market to trade. The first are margins, the amount of money required to open a position. If your margin is too low, you cannot trade. So what people tend to do is they replace low margins with high leverage, which increasing the risk of ruin of the whole account. If let me just show you real quick here, if I close this presentation, this is a AMP Futures, one of the biggest kind of futures brokers. And if you take a look at their website, you can see different margin requirements for different contracts, and you can see it's kind of funny because people always talk about how high leverage is in a crypto markets, but in futures actually the leverage is often much bigger. For example, the E-mini S&P 500 requires only $400 for a opening one contract during the regular trading hours. If you want to trade overnight, you need $10,000. This is what the maintenance means. But these contracts, obviously 1 point equals $50 in the E-mini S&P 500. So if you need only 8 points, if you have $400 in your account, you only need 8 points to go against you for your account to be gone. So but you can take a look at something like this, and you will see how much money you actually need to open one contract in each market. In crypto and in forex, the leverage is pretty high, so you will see that the margin requirements are usually really low, but this is kind of a minimum you need to have in your account to open one lot in each market. So the contract size obviously is something to consider. You need to choose a market that allows you to trade comfortably with the account size you have. You can face issues if your account is both too big and too small. This is something that I mentioned with the E-mini S&P. Obviously, if you have $1,000 in your trading account, you can technically open a 2-lot in a E-mini S&P, but should you do it? Of course you shouldn't. It's too big. It's too big for you. So obviously the opposite to that, which is not something most of you will experience, is that you can be too big for market you trade. If you choose to trade some obscure kind of shitcoin, and you wanna buy $100,000 worth of it, you might realize that it's just a too big size. So this is also something you need to consider. But most liquid markets, and most of you will just kind of experience this issue with having a smaller accounts for some of these markets, which in legacy futures can be fixed by using a micro contracts. In crypto there are no size requirements, so you can trade with $1,000 and even less. The trading hours, of course, it's not possible and also not healthy to look at these things 24/7. So you need to choose a market that suits your lifestyle and has the most active hours during the time you can actually look at the charts. This goes for day trading. Obviously, mostly there are in different markets. Obviously, if you in the legacy futures, you have something called RTH and ETH. The ETH stands for electronic trading hours, and RTH are regular trading hours that follow the hours from trading pits. these happen, in the morning sessions of each market. So in the US, this is at 9 a.m. New York time for the S&P 500, Nasdaq. Basically, when the stock market is opened, is the start of the RTH hours. In European markets, this is where the stock exchange in Frankfurt is opening. So if you are trading DAX or bonds or Euro stocks, the RTH starts at 8 a.m. 8 a.m. European time, So if you want to focus on day trading, you need to be able to pick the hours where you can expect, certain amount of volatility. Because, for example, if I want to trade something like DAX futures that trade mostly during the European morning hours, but I only have time to watch them in the evening. There is no point doing that. I need to adjust these things to the market that I choose. If you are trading crypto and you want to be day trading crypto, obviously it's a 24/7 market, so there are not any fixed sessions. But nowadays, market is moving at the times that US stocks open. So this is the start of the RTH session for the even S&P 500. They move a lot during the daily open, which is midnight in London, and also there are some movements during the London Open, which is 7 a.m. in London. So these are kind of a three windows during the day where crypto is generally moving, but the volatility in crypto can be a little bit less predictable compared to these futures markets that have more of a fixed trading hours. The last thing you need to consider is the order flow and general kind of a behavior of the markets. You have two types of markets. You have a thin and thick markets. Both have their pros, cons, and unique characteristics. When I will be talking about the markets, I will tell you which ones are thin and which ones are thick. So, first of all, what is a futures contract? A futures contract is a legal agreement to buy or sell at a specified date in the future. Originally it was a contract that was used for a hedging purposes in a commodities. Basically, you had a farmers that were using a corn futures to hedge prices of possible future fluctuations. So it's a agreement to buy at a specified date at a specified price. So thanks to the futures contract, they could hedge their exposure. Nowadays it's heavily used in a speculation. There are basically three main types of futures contracts, which are based on their expirations. There are quarterly, monthly, and perpetual contracts. Quarterly contracts expire every 3 months. These are, the mostly index futures, bonds as well. The monthly contracts expire every month. These are commodities, gold, crude oil, so on, silver. And the perpetual contracts can be found mostly in crypto, and these are this kind of a new way of contracts that don't actually expire. And the futures contract are traded on leverage by using a margin, which I already talked about. So the index futures, main kind of venues for them are CME, Eurex, Osaka Exchange, and so on. Mostly there are quarterly expirations, and there are both thin and thick markets. The most popular and traded index future in the world is the E-mini S&P 500 with a shortcut ES. I'm sure you have heard this before. ES is generally a thicker market. It used to be much more liquid than it is now, but it's still considered to be a thicker market. compared to a Nasdaq, which is a very thin market. So other index futures that are popular are Eurostoxx and DAX. Eurostoxx is index for the 50 biggest companies traded in Europe. The DAX is newly, actually, it used to be 30, but now it's a 40 biggest companies traded in Germany. DAX is a thin market compared to Eurostoxx, which is much thicker. All these index futures are heavily correlated though, so mostly it's a your personal preference of what you want to be, trading. If you don't know what index future is, I just, said it's a index of companies traded in a certain place. So bond futures, I'm not going to go in depth to bonds because I'm not, there is bunch of videos on YouTube explaining what bonds actually are. I'm pretty sure if I would go into this, I would say something wrong. So if you are interested to understand how bonds actually work, just go watch some video about it. But the most popular markets are the US and European bonds. In the US, obviously, you have 30-year, 10-year, 2-year. You have a ultra bonds. In Europe, you have Bund, which is extremely popular market. You have Bobl, that's a 5-year. Bund is a 10-year. They also expire quarterly, and all of them or most of them are really a thick markets. So there are good for scalping, and there are also very good to use different order flow tools. But also they are slow markets. Some people can't just stand trading slow markets like a bond, because when I used to trade the German bonds, I really could enter the trade and it could just like nothing happen. Even if it was like a intraday scalp, I would just get into the trade and could leave for an hour, and market would be trading at the same level that it used to be. So the bonds are really slow markets in most cases. Some of them, like ultra bonds, are pretty fast, and also bonds are from the futures markets the most expensive usually to trade. They have a higher contract sizes, so usually you need a little bit more money to trade bonds. Commodity futures traded on NYMEX and COMEX. These are the two most popular venues. NYMEX is hosting a crude oil and other commodities such as Brent. What else is there? Natural gas, heating oil, palladium, platinum, and all these kind of uranium and all these kind of things, and different gas futures. The COMEX is then a place where you can trade gold, silver, copper, for example, is also traded on COMEX. These expire monthly, and there are quite a bit of a thin markets. They moved a lot, they move really quickly. Obviously, people have this perception that gold is this kind of a safe haven thing which barely moves, but if you are trading in gold futures, they are actually quite expensive to trade, and there are moving really quickly, so on intraday basis. So it's actually not a cheap market to trade. Obviously, you can trade it on a CFDs, where the spreads on thin markets are usually quite okay. So if you want, there is options to trade a CFD on gold. Not so much on crude oil, as spread is a little bit bigger on crude oil. It's a 3-tick spread usually on most brokers. So that's a little bit border. So currency futures are traded on CME. There are quarterly expirations, and there are tin markets as well, and most of the volume is traded on spot forex. So what it means, obviously, if you go to CME, you will find a futures for euro, which is same as the euro USD. You'll find futures for British pound, which is the GBP USD, and so on and so forth. One thing you need to just kind of pay attention, if you look at futures for Swiss franc, Canadian dollar, and the yen, they will be inverse charts to USD JPY, USD Swiss, and USD CAD, because obviously you trade the currency, not this pair you have in a spot market. The order flow and volume for these markets is a little bit complicated, and I wouldn't, if you for example want to be day trading and really want to focus on one market, I wouldn't really choose a currency futures to do it. As I mentioned, I swing trade I trade the euro futures, but I mostly swing trade them. And the things that I use are completely fine. Also, euro futures are the biggest contract from these forex majors, but for like intraday day trading, the order flow can be a little bit confusing, because obviously the volume, the majority of volume is done in the spot forex market, which is traded over the counter. So you will often see this, that in futures market is just going down, and there is just kind of a buying going on a whole day in the future, which doesn't give you any kind of a actionable advice. So that's a little bit a tricky thing to do. I know some people who are actually day trading currency futures, but I tried that a couple of times in euro, and I didn't really find a too huge use in using order flow. But you can use other concepts, I will be covering, that are completely fine, market profiles, volume profiles, and things like that. But when it comes to these order flow nuances, it can be a little bit tricky. The last one, cryptocurrency futures that are traded, Bitcoin and ETH are traded on CME. Other futures are traded at crypto exchanges. You will see a quarterly expirations, but more popular are the perpetual contracts that were introduced by BitMEX, I believe in 2000. I don't know. I don't want to say the wrong year. I think around 2016 or 17, something like that. But there are basically the futures contract that are not expiring, so you don't have expiration dates. What I forgot to mention is, obviously at the expirations, these futures contracts are settled, but you don't have to be worried that you will be forced to buy a kind of a physical delivery of crude oil or gold, as basically majority of futures brokers will settle these into cash automatically. So it's just something to know. The crypto futures, like I said, the most popular contracts are the perpetual contracts. You have two types of them. The one is a quoted in stable coins, so you basically are using in most cases you are using Tether, so you are trading BTC USDT, for example, and your whole account sits in a Tether. And the second ones are the inverse contract, where your whole account is sitting in a coin. So if you are trading BTC USD, your whole account is in a Bitcoin, so you are also exposed to the fluctuation of coin itself, not only your trading account. That's something that is worth to mention. But some people prefer it this way. If your goal is to have as much Bitcoins as you can, trading in account which is denominated in Bitcoin is, why not. Cryptocurrencies are in markets. They move a lot, they move quickly, and there is a order flow fragmentation in crypto, which is a kind of a interesting topic, because obviously you have so many different exchanges where people are trading. You have FTX, you have Bybit, you have BitMEX, you have Coinbase, Bitfinex, and so on and so forth. And this kind of brings a question that, if you use these order flow tools like a footprint charts or whatever, or look at DOM for one exchange, how you can make any kind of sensible things from it when it's so much trading is actually happening in different places. And this is a good point, but what you will find out and what I will kind of show you is that the way that I look at things is to kind of looking at the retail participation in crypto, because it's such a huge thing in crypto. Obviously, there are certain exchanges where you have just a retail traders doing a crazy things, and you will kind of be able to just from one exchange understand kind of a whole sentiment of these participants. So the order flow fragmentation is a little bit of an issue in crypto, but it's not too big of a deal when you understand things you want to see and things that you are looking at. Okay, so these are the different markets. Like I said, pick the market based on mostly your schedule if you want to be day trading. If you want to be then swing trading, I will be talking about this a little bit more. You will then have to kind of consider things like correlations and stuff like that. So we will cover that a little bit later on, but this was just a brief introduction to the different markets and which one you should be choosing.